This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. This is Jonah Lupton. Welcome back to the Investing with the Whales podcast. I think you all know my next guest. It is Peru Saxena from Hong Kong. Twitter is a very popular guy on Twitter that we all follow and enjoy his commentary and whatnot. So let's just jump in. Peru, what are your thoughts right now on the overall markets? Are you bullish, bearish, somewhere in the middle? And then explain why.
For sure. Thanks for having me back on your podcast show. I think, Jonah, the stock market has been pretty bifurcated. If you look at the last 6-7 months or so, it has been one of the most challenging tapes I've seen, and I've been doing this for 20 plus years. We had the first waterfall decline in all stocks in 2022, which basically culminated in the S&P bottoming out in October for now. And then we had the bottom in November, like a double test of the lows in late December, early January by the NASDAQ. Some of the growth stocks bottomed out in May, June last year, and they've been consolidating for almost a year. Some have started breaking out to the upside already. So this has not been a uniform tape at all. It's been all over the place, and sectors have been, moving in and out. There's been massive sector rotation, style factors and all, what have you. So it has not been a bear market where everything has moved together, and that is quite rare. That doesn't normally happen. Normally, all sort of stocks move up and down in bear markets together. So it's been very challenging, and also, I think, the first leg down in 2022 was primarily due to the rapid increase in long-term interest rates. So the discount rate went up like several 100% very quickly. And valuations, as you know, were very stretched in 2021. I actually warned about the coming bust. I did not foresee the magnitude of the bust, but I knew very clearly that the bull market was ending in late 2021. I did a podcast with Dave Lee where I mentioned, the bull market was probably ending. And I got a lot of criticism and hate back then saying, you have no idea, you just, an old timer, you don't know, and all that kind of stuff. So, that's all fine. So we had the first big leg down in 2022. And then the liquidity started expanding. So, the balance sheets started going up again. Bank of England intervened, if you recall, last autumn with their gilt crisis. And then they basically printed money or reserves. And then you had more intervention recently in the aftermath of the bank failures in the US. The Fed's balance sheet went up a lot. Admittedly, that's not QE, but they did actually print dollars and added to the reserves. And that again helped asset prices in the near term. My view is that we are likely headed towards a hard landing in the US. The data is screaming recession. If you look at the leading indicators, the leading indicators have been screaming recession for the past several months. The yield curve is severely inverted. The banks' lending standards have been tightening. If you look at the loan surveys and stuff from which have just been reported today, right, they're showing that 46% of the banks are basically tightening their credit standards and lending standards. And if you also look at the commercial banks in the US, the deposit base is in contraction. The money supply is contracting year over year. So all these indicators are suggesting that the US is headed towards a hard landing later this year. The coincident and lagging data is not showing that yet. So if you look at the unemployment rate, that just hit a new low, and everyone is saying, "Oh, look, there is no recession. There is a soft landing. Everything is fine." But I would like to remind everybody that the jobs data is one of the most lagging indicators and data points out there. By definition, the jobs market has historically been very strong heading into every single recession. So I wouldn't, take that as the gospel that, oh, everything is fine. I still think we are going to see problems in the economy, perhaps in 2 or 3 months from now. My base case still is that there is going to be a recession in the US, probably, somewhere around August, September time, give or take. And I don't think the indices have sort of discounted that already. I may be wrong, there are no guarantees in this business, but I don't think that the indices have discounted that already, especially a severe recession. If you look at, the growth stocks, which you and I invest in and we track, they've already been bombed. They've already crashed and burned. They're down 80, 90, 95%, some of them. So I would argue that they have already discounted a lot of the problems and the valuations are now pretty compelling. And if we do get into a recessionary scenario, I think long-term interest rates are going to go down. The Fed will cut rates aggressively, and that's going to be a tailwind for these long-duration assets, which have already basically been taken to the woodshed. So I own shares in software, e-commerce, and fintech payments companies, EVs, and so forth. I'm also actively, shorting the Russell 2000 index futures, RTY, as a hedge in the portfolio.
Why do you short the futures rather than just the underlying ETF like an IWM or IWO?
You could do either. I have the capability of buying and selling futures in my account, so I just find it easier to short the futures because they trade 24/7, Monday to Friday. So I just find it easier, but anybody can do either. So I'm actually betting that the economically sensitive sectors of the economy, like the banks and the IWM and so forth, those companies are likely to sort of feel the pain more in a recession than these high growth, secular growth names, which are invested.
Because even though the SPY and the QQQ are doing decent year to date, the QQQs are doing better. Those are the market cap weighted indexes, whereas the equal cap weighted indexes are doing much worse. So is that, I know last year you were ahead of the curve saying that, the generals are the last ones to get shot. We've seen the generals bounce back, once Meta did their cost cutting, lowered their CapEx, big headcount reduction. You saw, Meta spike. NVIDIA's come roaring back because of their AI push. Microsoft, really never fell too hard. Apple didn't fall too hard. But it seems like that's where all the money's going. Everyone's hiding out in these generals, and the valuations feel sort of stretched. Do you think do they need to get shot again?
Well, it depends on how bad the recession is. If earnings fall off a cliff and you have a real hard landing in the US, which I wouldn't rule out at this stage, by the way, it is conceivable that these names will also come down quite significantly, because we are now in that phase, this Goldilocks phase, where the Fed is apparently done, or the Fed is pretty much done at this point. They may raise rates another 25 basis points, but that's a very high hurdle to jump over. So by all practical purposes, if the Fed is done, the market is now celebrating the end of the monetary tightening, and the economy hasn't started really significantly weakening yet. So we are in that honeymoon period where the Fed has actually done its thing and the economy still looks pretty strong. But, as you know, that monetary policy works with a lag.
Right.
Things
there's a 6 to 12 month lag effect on rate hikes, right?
Correct, 12 to 18 months in some cases. And also, don't forget, we've had these stimulus checks which were sent by the US government, helicopter money, which was financed by the Federal Reserve doing QE. And all that money is still basically sitting with, not all of it, but a lot of it is still sitting with American households. So I looked at some data from JP Morgan, and it says that the US households are now basically burning $120 billion a month from those stimulus checks and savings. And at that rate, these excess savings are likely to disappear within 5 or 6 months. And I think that's when you will start to feel the real impact of the ongoing monetary tightening and the tight monetary conditions, because the free money which was sent by Mr. Biden during the pandemic is going to disappear. And also the lags of the monetary policy will become more evident in 2 or 3, 4 months from now.
I'm in the camp right now that we're not going to have a recession unless we see severe disruption in the credit markets, We see unemployment rate going up. But those are two things that could certainly happen.